Hi, everybody. I hope you can hear me. I'm going to ask my fellow panelists to unmute themselves, and we'll get started. So I want to welcome everybody. My name is Brenda Meltebeke, and I'm a partner and chair of the Entrepreneurial Services Practice Group at Tonkon Torp, and I'm the moderator for today's panel, Investor Perspectives on Raising Capital in Uncertain Times. Our hope is that we will provide you with practical advice to help your business thrive during the pandemic. If you have questions unique to your business, we invite you to reach out to our panelists directly after this webinar or to the Tonkon Torp lawyers that you normally work with to advise you on your specific situation or specific questions. Today, we're going to hear from three distinguished panelists: Matt Compton, a general partner of the Oregon Venture Fund; Julie Harrelson, Managing Director of the Cascade Seed Fund; and Tom Kingsley, Advisor to Entrepreneurs and Active Angel Investor. So I'm going to shift gears for a moment and give you some information about how the format will work today. First of all, I want to let everybody know we're recording this webinar. You don't need to sign a disclosure form, and no private information of yours will be shared with anyone. But be aware, if you choose to participate in our Q&A session, your name may be recorded in association with your question. Please feel free to submit questions in the Q&A section of your Zoom app. We want to be sure we have time for all the panelists, so I may not ask your question right away, but we're going to have a Q&A section. We're going to reserve the last 10 or 15 minutes of today to answer your questions. But also, I just want to make sure that people understand that because the pandemic COVID-19 situation kind of is changing so quickly, we may not know the answer to your question today, or it may be too specific or nuanced for us to address in this webinar format. And if so, please feel free again to reach out to one of the panelists or to your Tonkon Torp lawyer after the fact to follow up. We welcome any feedback that you may have after this webinar. If there are topics you want to hear more about, please tell us. We hope to be a source of information for our business community throughout this challenging time and plan to hold additional seminars going forward. Last, but not necessarily least, the information we are presenting here is as of today's date, May 5th, 2020, and is not intended to be legal advice. Thanks so much, and let's get started. So I think the first question I want to ask, and I'll just start with Matt, what current financing trends are you seeing for early to late stage companies? Are you seeing changes in terms, changes in valuations? Is it taking longer to get a term sheet? And I'd really love to hear from all three of you on this question, if you don't mind.
Sure. First of all, I hope everyone's staying healthy out there. I know these are tough times, and make sure you're focusing on your health and your family's health. And that's probably the first thing we'd say to any company, actually. So I'd say one of the big changes that happened kind of immediately is in early stage companies, a lot of times we talk about funding 12 months of runway, and 18 is the new 12. So we focus on 18 months of runway is a better number that we like. And on later stage companies, you might even ask the question, is it 18 to 24, and can you even get to break even? And you know, the second thing that we're seeing a lot is what does that funding buy you? What can you actually do during that time? And that's a little bit more of a focus question now, I'd say, in early and late stage financing. And so if you're an early stage company, can you build your product during this time? Can you actually get customers to interact with you and engage with you and give you feedback on your product? That's a really important thing to understand. And the companies that can do it, you know, will continue to get investment. For later stage companies that are in go-to-market phase, it can be pretty tough right now. And so, you know, we look for things around, are you able to get traction? Is there a tailwind maybe even created by the COVID virus? And I think we'll talk about some of the examples of tailwinds a little bit later. And then just speaking more generally, we'll see fewer new deals over the next couple quarters in the VC industry in general. I think a lot of firms are tilting towards their existing portfolio. And I believe we'll see valuations come down as well. So I'll stop there and let the other folks talk about what they're seeing.
Thanks, Julie.
Yeah, so thank you, Matt, and thanks, Brenda. So I was going to say what Matt said. And and also, so Cascade Seed Fund is a seed stage investment firm. And so one of the trends that we're seeing is valuations were starting to trend in an upward direction pretty quickly. And we're seeing some of that cool down. I've done, I do a lot of reading, trying to stay current on what's going on. I have seen some articles about BC money getting more aggressive in terms of terms. We're proceeding on kind of a deliberate path, not making any major changes in our terms, but we do see that valuations are definitely coming down. And also, again, we're not seeing a lot of new companies. So we're seeing companies that are already in one of our fund portfolios, or we're seeing, companies that we've been in conversation with the last 6 months. So not a lot of new activity.
Okay. Tom?
Yeah, it's pretty much the same thing. Mostly the investors, I guess a lot of people are characterizing, somebody used the term, they're tapping the brakes. I prefer the term, they're coasting. That said, there's still activity going on. An angel is associated with early stage investment. So early stage very much depends on the business. And there are some businesses that seem to be at an advantage because of the COVID virus. And there are others where they're at a disadvantage because there is uncertainty. What I see mostly with the startup companies and the portfolio company underscored, which is that everything's getting pushed out timing-wise.
Yeah.
So financing, revenue, bookings, and then the other thing that's happening is there's a disruption of certain activities. Very much depends on the business that you're in, but as Matt mentioned, being able to get customers to interact. So, for example, if you're in a healthcare-related business, to get a hold of practitioners right now because everybody's pretty damn busy. So, if you're in the middle of doing a market validation, there's the pause button on that. So, in terms of an overall strategy, the expression that I'm using with portfolio companies and people that are starting up is an expression I learned back when I was working for Avnet, an electronic distributor, which was when there was a bit of politics in the company. One of the top executives advised me, I was much younger, he said, he lived in Manhattan Beach. And so I grew up in LA and, it's all about surfing and body surfing and everything. He said, there are times when you just got to dive down and let the wave pass over. So I think generally the mood is that, yes, it's going to come back, but the question is how long? And, eeny, meeny, miny, mo. I think 18 months versus 12. In other words, I think adding 3 to 6 months to whatever you're looking at is a good curve, unless you happen to be a lucky industry that's actually accelerated by what's going on. And there are a lot that are. And then the other thing I'd underscore is valuations are definitely going down. So, and when you push something out further, of course, the valuation is going to be lower anyway, because now you push the curve way out. So the investor perspective is that, look, you're now still early stage and you're going to be this way for a while. So we can't pin the valuation as high as we thought, because you're not going to do your series raise or your next raise or meet that next milestone in 6 or 12 months. It's going to take 12 or 18. So, and then the other problem is just that while there are funds and investors that are still out pretty aggressive in terms of looking at deal, or they're pushed by deal flow that they have to do, like the Oregon Venture Fund or the Portland Seed Fund, maybe Cascade. Because of that, those entities are actually as aggressive as they were in terms of looking at deal flow and trying to bring new business in.
Thanks, Tom. Let's go to the next slide. And I'm going to start with Julie for this. So what are the 3 things that your portfolio companies have done, or 2 things, or 4 things, in the past 60 days that might have built strength in their companies or are helping them solve any particular crisis? Have you seen people pivot to a different aspect of their business? Are people changing, their pricing or their business or revenue model? Or are they doing none of the above and something completely different?
Yeah, thanks. This is a great question. So I'll give a couple examples. From my perspective, Brenda, and I'd like to hear from the other panelists on this too, this is as much a question of leadership as it is about the tactics to survive, right? So we're seeing some interesting things that CEOs and founders have done with regard to their teams. One in particular that I thought was great, given the pressure and the stress, I think it's easy just to, get busy and try and survive. But in one case, one of our founders actually calls everybody on his team every Friday and checks in with them. And I think that that's done a lot for team cohesiveness and kind of keeping the momentum when everybody's a little bit in survival mode. Another one regarding inventory. So we have a portfolio company that ended up with, they had a lot of kind of, this is a technical term, odds and ends in their inventory. And they basically combined and productized that and did a special offering. So direct to consumer company did a special offering that sold out in like 3 minutes. And the third thing I'd say, and we'll probably get into this more is in a recent panel I did with my business partner, Robert Pease, someone had told him once, now's the time to move from PowerPoints to spreadsheets. And I think that cash management is a huge part of this. So companies that have been able to get their arms around the facts, because I think in this kind of circumstance, facts are friendly, that to say, how much cash do we have, and run different scenarios so they've got a worst case, mid case, best case in terms of navigating this and diving under the wave, as Tom said.
Great, thanks. Tom, what are your thoughts on that?
Well, I echo everything Julie said, and it's a matter of, really it's a matter of triage. Cash, I'll go to cash first because I think at the bottom line, that's the most important thing. Because you're going to have to, unless you're in the fortunate situation where you're generating more cash than you can use, which is unlikely, you're gonna run out sooner or later, or you're gonna have to push out the point where you're cash flow positive, and so you have to do some things to do that. You know what people are doing? Obviously, the first thing that everybody went after was to try to get their hands on some of the money that the government is providing with the PPP, unemployment. That's been tricky. There's a lot of red tape and obstacles that exists in a normal world that get in the way of doing those things. But what I've heard on the other hand is I just saw an email from Angela Jackson that says that many of their portfolio companies have been able to take advantage of the PPP. Mm-hmm. So a couple of the companies I talked to said, well, unfortunately, most of the people that we've got working are working as contractors, not employees, so they can't get unemployment, and we're not eligible for PPP. The answer to that also depends on the bank. So if you're not getting the answer you like from your bank, talk to some other banks. The only other thing that I'll say that's strategically important is triage. So looking overall at the strategy and considering pivots, and even if they're temporary pivots, for example, in terms of having a special offer, as Julie mentioned, you see the retailers doing this right now. As soon as the lockdowns occurred, all of a sudden, boom, you could get really good deals from a lot of the bricks and mortar retailers. The same thing can be done, possibly can be done for your product, and you should stretch your mind and brainstorm and see if you can figure out ways to do things like that. And then the last thing is to be, unfortunately, as I like to say, clear-eyed and ruthless about playing eeny, meeny, miny, mo with resources and people. And it's unfortunate but true. that sometimes you're faced with, okay, which one, my left hand or my right? So I would say that the companies that do what they have to do are the ones that are going to survive. You just need to make sure that you do this in a way that is done in coordination with good HR practices, and get plenty of advice. Don't rush into it. Talk to your board, talk to your advisors, talk to anybody you can to get a sense of whether or not what you're doing is right. The other thing I see is that there's some companies that have transitioned, for example, or trying to transition to pick up more business internationally, particularly in those countries right now that seem to have already recovered, such as in Asia. That is also something very, very difficult to do, but these are completely unprecedented times, and desperate times call for desperate measures. Necessity is the mother of invention. So take a look at that. If it's possible, do it. I think that's about all I can think of right now.
Thanks, Tom. Matt, do you have anything you want to add to that?
Yeah, all really good points. We at OVF, we pretty early on connected with all our CEOs, and Julie, you were alluding to this a little bit, but it was actually a really cool conversation with all of them. It was really inspiring. So just to go off on a tangent for a second, just hearing all the CEOs be objective and action oriented and empathetic, it had this weird effect where it was almost more motivating than a conversation when there wasn't a crisis. And so I thought that was really fun and interesting and inspiring to connect with all our founders and CEOs over a pretty short time period. And a couple things came out. So first one was just this focus on employee and community health. So that was, this was way back in March. So at the very beginning is what are the companies doing to ensure employee health, and how are they contributing to community health? And that was kind of front and center in those early days. And then back to this 18-month conversation. So rebuilding an operating plan that has 18 months of runway with reduced revenue assumptions on current cash. And that's a pretty tall order for an early stage company. And that typically most of the expenses in venture funded companies are payroll. So that usually included some sort of furlough for the companies that didn't have a tailwind from the coronavirus. And, we're resourced for that. Our CEOs and CFOs are super capable, but we helped with those conversations. One thing that people did, I guess hasn't come up yet, is some folks thought about options in lieu of salary as a way to kind of extend runway. Other folks just had to flat out be pretty decisive around furloughing. And one of the challenges, as we all know, is the longer you wait, the less impact it has on your runway extension. So people had to make pretty fast decisions, and the ones that did are more likely to survive. And so those were interesting conversations. And then maybe on the more positive note, Tom alluded to this a little bit, but this idea of accelerating new product features that take advantage of the current conditions. And so an example would be Allie over at Hub. Hub has a software platform for managing conferences and events. And, that's problematic right now, given people aren't holding, we're doing this virtually. They had some features in Q that enabled the platform to manage virtual events. And so by accelerating that, they went from a headwind to a tailwind with just a relatively, I don't want to say it's easy, but a doable enhancement to the product. So that kind of creativity that crisis drives definitely comes out during these times. And I've actually been surprised how many companies have been able to add a feature set or even sometimes tweak a positioning, and it really creates a tailwind environment, or at least overcomes a headwind.
Great. Thanks for all of those. They're all great ideas. I think we'll move on to the next slide now. And so I want to talk about where investors and funds, both angel investors, individual angel investors, and angel and venture funds are investing now, and whether, for any of you or your funds, if your investment strategy is changed in light of the pandemic, or if you're kind of holding fast to the investment principles and or philosophy you've always engaged in, or if that's changing. And why don't we start with Tom?
Well, I haven't changed my approach, which is always, the interesting thing is I teach a class that I inherited from Jim Houston at PSU to graduate MBA and MFA students. It's called New Venture Finance. And as part of this, we ask entrepreneurs and the investor that invested in them to come and speak. And I think Matt has come once or twice. And so we had David Nelson, who started Gift Tango and now is doing a startup called Bumped. And Greg Ennis from Peninsula, who invested in Gift Tango and is also into Bumped. And one of the students asked, what do you do to make sure that you're up on whether or not if you get a term sheet, how do you know it's good? What the market's like. And he said, well, that's the unfortunate thing, which is that as an entrepreneur, your fundraising activities, while the old saw is that the CEO should spend 50% of their time fundraising, that they're at a disadvantage to investors because investors are constantly, that's their job. They're looking for businesses to invest in. So they're going through deal flow. They're talking to a lot of companies. They're putting out term sheets. They're very aware of what the competition is doing. They're syndicating, so they know what the competition is doing. They're leading, they're joining in. So he said, the problem is that, I would come back to it. This is David speaking every couple of years, and I would find that the landscape had changed. So the point is that it's always changing. And this was a big impulse, as we say in engineering. It was a real huge meteor that landed and blew up. And it's changed the landscape significantly. But what has happened is that has caused investors to redouble that are still moving forward and look for what's going to be good. And so I think you can still count on that. There was a great letter from the Portland Seed Fund that came out. I'm in the Portland Seed Fund too. And it came out shortly after this that just talked about the fact that they were moving ahead. And as a matter of fact, they were investing more in certain companies like BrightMD, which is doing a medical application. I saw a company that pitched to Ty the other day that had a community and an app enable people to gather together and exchange information and exchange goods and exchange knowledge and expertise. They shifted to doing that for medical workers. And so there was a lot of interest in that. Because what you're looking for basically is you're saying, okay, well, this is the situation now. Are there any companies that actually can be taking advantage of this? That's number one. And then the other thing is, well, if they aren't taking advantage of it, do I still believe that at the end they're going to come out and they're going to grow? And so how do I want to modify the terms then? In other words, I'm still interested, but maybe not at the same terms.
Okay. Matt, what can you add to that?
Sure. So I think probably the short answer would be our strategy doesn't change. We're still looking to invest in the best high growth companies in the region and support them as best we can. And but the tactics have tilted a bit. So we are tilting towards the existing portfolio, and we're still making new investments. There's probably a little bit more tilt towards experienced management teams that have been through a recession, been through an economic downturn. And there's on new investments, there's definitely a tilt towards really clear product value prop differentiation and something that saves money or makes our customers more efficient. So sort of real practical but differentiated value prop. We kind of, back to that idea of what phase the company's in, we kind of look for two phases. So an early stage company that's building the product during this time. This is actually could be a great time, the next 12 months, to be building a product, as long as they can get the attention of beta and alpha customers. Because if you can't do that, you can't build a great product. So that's one kind of thing or lens we look through. And then on a little bit later stage companies, it's back to can they get attention from a go-to-market perspective? So are they experiencing a tailwind? BrightMD is a great example of that one in our portfolio. They provide telehealth and workflow for patients. Lumen Learning is another example. They have digital higher education course content that helps with virtual learning. And these are companies that are actually seeing tailwinds. And they're out there, absolutely. And those companies won't have the same go-to-market challenges as most other companies and can be great investments.
Thanks. Julie?
Yeah, so just an example of that. I think both Matt and Tom mentioned this, but we're seeing, like we recently made an investment in a travel-based company, which seems completely contraindicated, right? But they have a chance to actually, you know, leverage those funds to build the product and the team, and really be ready to come out strong when things start to open up again. So I think that the other piece of that is, are we changing our investment thesis? No, we're Oregon first, Pacific Northwest interested investors. The companies we invest in are typically sub $8 million in valuation. They have you know, some revenue, so some early product market fit. And we're often the first institutional money into a company after people have done a, you know, friends and family round to prove their concept and get some momentum going.
Thanks. Why don't we move to the next slide? And Tom touched on this earlier, but we're going to talk about it a little bit more, although I just want to say a couple of things before I ask our panelists to weigh in. So what about PPP loans? You know, have any of your portfolio companies applied for them? If so, you know, have they received them or not, or had difficulty? I would just add, I've had a lot of clients, actually. I've been surprised by how many of my clients applied, and to my knowledge, all the ones that applied got them, because they were, I think partly they were on top of it immediately. The problem, of course, is the guidance. And so with respect to that, which the guidance keeps changing with respect to that, I would just also direct people who want to know, you know, a little more specific information about the PPP loans and what to expect, is to go to, if you go to our website, the Tonkon Torp website, we have a COVID-19 resource page, and there's information about PPP loans there. But Matt, I would just ask, is there anything you want to say about PPP loans? What, you know, OVS companies, have we had many companies that have applied for them? Did they receive them?
Yeah, what a complex and rich topic. So have we done our kind of caveats? We're not lawyers or SBA lenders, and these are just general comments, all that
Right.
good stuff. No, and we have had to become more knowledgeable on this than we ever imagined. So a lot of companies out there are applying for the PPP, and a fair amount have received them, actually. And, you know, I think, you know, one question I think everyone needs to ask is, has the company really been hurt by the virus? We don't believe this is a free-for-all, grab every dollar you can. If your company has been damaged by this pandemic, absolutely apply and go try to get those loans. And so that's kind of the starting point. And then I think the other thing, you know, we talk about is, I think everyone knows there's a forgivable portion if it's applied to payroll for, I think it's like 8 weeks from the funding date. And then the rest of it turns into a loan at 1% interest. And I think I got those facts right. And it's about a 2-year loan that starts paying back in 6 months. So anyway, there's these two components to it. And there's sort of the quote free money aspect of it to frankly fund payroll. And that's a great resource that companies for whom it's a fit should take. The other half, we just want to make sure folks don't miss, is the other half is a loan. You are taking on debt. That's going to need to be serviced, yes, at a low rate, but it's going to be paid back over a fairly short term. So debt can be a great tool if it's bridging through you basically time shifting cash and bridging through a valley, or if it lets you grow more quickly. But just taking on debt to just extend runway to nowhere isn't usually a good idea when you know you're going to have to service that debt. So we're just encouraging companies to think about those two components of the PPP and not forget that there actually is debt that needs to be serviced for the non-forgivable part.
Great, thank you. Julie, do you have anything you want to say about PPP loans?
Matt, really well said and great explanation. I think so. This is anecdotal from our end, but it's been spotty and sometimes seems like a little bit like magic. Who gets it? Who doesn't? But I would say this is a case where having strong business partners in terms of bankers, attorneys, CPAs, advisors is super helpful. I mean, it's like a use case for it, because I think those that had strong partners and good communication and got on it early had a much better chance. But it's one of those situations where the guidance is changing really rapidly. It's a very hard thing, I think, for people to navigate. their way through. And so having that level of expertise has been a real strategic key for the companies that we've worked with.
Great. And Tom, do you have anything more than what you previously mentioned about this subject?
Just a couple things. One is that I have, so what we heard and Julie, in terms of what companies are actually doing in their portfolio, is a lot more information than I have. I know I did hear from Tonkon Seed Fund today that many, as I mentioned, many of their companies were getting hands on feed. And I would echo Julie's recommendation. It's really critical to have a good banker to be working with, to have a good, strong, if you don't have a CFO, go get somebody in finance to help you with this, and good legal representation as well. And the legal, by the way, includes, I would say, the HR aspects of this, because there's complications based on employment laws that tend to have gummed up the works for several people when they try to do this.
I would agree, and I would again just say, if people want to think more about PPP loans and the guidance and also the HR aspects, please feel free to go to our website and look at our COVID-19 resource page. Okay, why don't we move on to the next slide? So this is obviously a little more open-ended. What are you, as an individual investor or as a member of a fund, as a manager of a fund, telling your portfolio companies? And we've sort of touched on some of these things probably before, but if you have, you know, particular insight as to what you're telling even specific companies, or just generally what you're telling your portfolio companies, I'd love to hear about that. And why don't we start with Julie?
So this goes back to the thing about getting off the PowerPoint and onto the spreadsheets. We're really talking to the companies in terms of looking at this as a survive and then sustain and then grow. And we're shifting, we're kind of looking at that structure and kind of shifting the timing as we learn more. So it's like, you know, survive in Q2, Q3, sustain, and then move into growth in 2021 at some point. And it's really difficult to, you know, we don't have a crystal ball. The data analytics aren't there. It's a really fluid situation in that sense. So it's about being able to bridge into the future. And I would say that's probably the core message. And I think also, again, back to the question around leadership as an investor, you know, our perspective too is that you know, everybody needs to stay well in order to have these companies thrive. So making sure that people are, you know, doing what they need to do to have their team thrive as well.
Great, thank you. Tom?
I honestly don't have anything to add to what Matt and Julie said. I think they've covered the waterfront there, other than what I've already said. I guess I'll make this one comment, which is that the human species, for better or worse, our strong suit is adaptability. And that certainly is the top strength. If you do a SWOT analysis, what are the important strengths that you have as a company is to be able to adapt and adjust, and looking at different ways to implement your product and prioritize that, prioritizing your cash flow, as Julie mentioned, and looking at different ways to sell. I'll give you another example. The Dirt, for example, which is a camping recommendation site, campsite recommendation site and app, has found that they're getting a lot of business with people who are going glamping. So glamping, if you didn't know, is glamour camping. And it turns out that while at first they were going for bookings that they were going to take a piece of that were federal and state, which are 80% of the campsites in the US, they found, because it emerged, that private campsites was really growing, and they had a real need for references and for a platform by which they could book. And so they focused on that maybe a year or so ago. And I just talked to the CEO, Kevin Long, recently, and he said that they were getting a lot of bookings and recommendations for glamping, which are people that take really nice RVs and find a private place that is renting out to the RVs and camping there. And this is a nice private place. This is not like a Campground of America kind of place. These are people that have private property. They've fixed it up a little bit, and it's a great place to go if you've got the RV or the station wagon with the tent to do it. So those are the kind of things, is adapt or die. You have to do it. And I guess the last thing I'd underscore is Julie's comment about the human aspect and concentrating on yourself and your team to make sure that everybody is staying mentally healthy as well as physically healthy.
Good point. Matt?
Yeah, you know, I think when you're in a really dynamic environment with lots of change, it can be easy to say, you know what, we just don't know, so we got to wait. And you know, we don't accept that, I guess, from a CEO perspective, from a founder perspective, from our perspective. I heard this great quote once that great leaders can provide clarity in a world of ambiguity. And the idea is, yes, it's complicated. We don't know exactly what's going to happen, but you can shrink the problem. So there's some core events coming up. At some point, retail is going to open. That's an important signal to the world. At some point, kids are going to go back to school. That's an important signal to the world. There'll be a treatment and there'll be a vaccine. So we can start shrinking the problem to understand and build plans around it for all these companies. And so we're really encouraging founders and CEOs, and the great ones are already doing this. They have a plan, they're adaptable, they're willing to change the plan if new information comes in, but they have a plan and they can communicate clarity to their team. So that's probably one of the strongest themes or messages that has probably come through in our talks with all our CEOs.
Have any of you had conversations with your CEOs of your portfolio companies just about dealing with fear, both their own sort of personal fear for their own circumstances, for their company's circumstances, as well as helping their employees and their contractors deal with the fear and the uncertainty as well, and the personal, you know, issues about whether it's about health insurance, you know, if they live alone and there's, you know, they don't have somebody to talk to when they go, well, I guess they're working. Sorry about that. They're working at home, so they're not going home after work. But do they have people that can be supportive of them?
I'll take
Matt,
talk to it a little bit if you want. Yeah, or whoever. That's a great question, and it just is highlighted in times like this. And I think it's interesting. We can't physically be in the same place together, yet in a way we're able to connect better. I mean, you all are seeing what my house looks like here, and we're seeing kids run behind us and dogs and cats, and it's almost more real even though we're not together. And so sort of finding a way for that to get that connection between employees and, you know, the founder or the CEO is really responsible for leading and showing vulnerability and be willing to kind of be open and express their own concerns, but still have a plan. So I don't think I have a specific story around, but just hearing some of the stories around connection that people are able to still make in a virtual work world, I think has been pretty inspiring and seems to help.
Yeah, I think that, you know, there's been a lot of literature that's come out in the last couple of years about mental health and entrepreneurs. And I think we all can have a tendency to be kind of high strung and driven in a certain way. And so I think, as Tom talked about, having HR resources that are helpful, staying related, like Matt's talking about, and also people asking for help if it's needed. You know, it's a ambiguity and uncertainty is something that always exists, but this is a situation that really emphasizes it. And so you know, I'm not a mental health professional, and I'm not an HR person, but I do think that, you know, being aware of that and our own, you know, our own needs in that regard and the needs of our team is a really important feature right now, because there is a lot of fear.
Well, and it can paralyze people, which is not what we want. To Matt's point earlier, I think about you have to keep moving forward.
Yeah, I read.
Tom, did you? Oops, sorry, Julie.
I just read something the other day that said it's a kind of a human mechanism that when things are positive, people keep expecting them to get more and more positive, and then when they start to get negative, people just keep thinking that it's going to get more and more and more negative. And I think that someplace in the middle of that is the balance, and that everybody has a different way of finding that. But if you are a founder, you know, the pressure is huge, because we're so close to our success or failure. We're not inside a large resource-rich organization, right?
Very true. Tom, do you have anything you want to add about that?
Well, yeah, just in general, I'd say one of the things that with companies that I'm engaged with, one of the things that I do, and I did this actually when I was CEO, is spend a lot of time talking to different people at different times. And in this case, we're talking about the founders, just to make sure that whatever, you know, was keeping them up at night or chewing their nails during the day about was something to talk about. And a big part of it was just to let them know that it's normal. Starting up a company is one of the hardest things that you can do. And it's not a question of whether or not there will be problems or if. It's a question of how big are they going to be. And so prepare yourself and do not be surprised when it happens. I kind of learned this myself quite a few years ago, and I was traveling a lot internationally. And I used to be the kind of person that if my flight schedule was interrupted, the plane was late, so you missed the connection, and you didn't get the international connection, or you didn't get the connection, and there was a big customer meeting or a session going on. Watching how different people reacted, because everybody is different, really taught me that it does no good to get upset and angry about something. And so what I would say is that it's very important for the leader, the CEO, to lead by example and help people recognize that whatever is going on is not going to it's not going to be the end of the world, and help them through it. The only other comment I'd make is to remember that everybody is different, and everybody is experiencing something different. You never know what people are thinking, what they're going through, and a lot of times you may not know things that are going on with them that are very serious that they haven't told you about. So, you know, don't assume, and treat everybody as if you're not quite sure what their situation is. They may be in a very desperate situation financially or medically or with personal relationships or something like that. You don't know anything about it. So just be careful with people, and your role should be to try to help them and develop them. And to do this, you got to meet them where they are and recognize everybody's different and everybody's experiencing this whole thing very differently.
Well, I would say that's all good advice on this. And I do want to move on to the next slide, but I also want to remind all the people who are listening to our panel discussion that if you do have questions, please feel free to submit them in the Q&A section of your Zoom app, and we will get to them shortly. So we talked a little bit about this earlier when we talked about, are you changing your investment philosophy or your investment strategies? Is your expectation now that your outlook will change by the end of the year? Do you think it won't change really kind of how you're going about things now until you know, mid-2021? What's your expectation about that? And Matt, would you mind going first on that?
Sure. That's an easy question. Yeah, I mean, I think we will have some more clarity by the end of the year. If I'm trying to be a little bit more practical, I think we'll have a sense of what's going on with, you know, workforce, retail, office work. kids in schools. I think those are big triggers. We might have a read on treatment a bit. And, you know, I think I'm probably a little bit more excited about kind of the first half of 21. I think there's also this dynamic that we've all heard about where economic downturns, recessions, whatever you want to call it, can be great times to build companies. And so on maybe a bit more optimistic note, when you think about those great entrepreneurs out there that maybe were working in a big company and maybe their company went under, maybe they lost their job. They've always been noodling about that great idea that they wanted to go out and pursue. They're starting to work on that now. You know, over the next 6 months, they have a chance to build a product, talk to potential customers. The opportunity cost of doing that's a lot lower than it used to be. And they're starting to get some of that traction. And by the first half of next year, they're ready to raise some money and really start driving those first initial customers for the product. And I think next year could be a pretty interesting time to do early stage investing. So I'm starting to feel optimistic about that. I think there's a lot of stuff we don't know yet, but I think in kind of early or first half of 21, I think the outlook, given it takes so much time to build a product and build a company, you kind of want to be catching that recovery, whether that's 2, 3, 4 years from now when you're actually going to market. So I don't know. Those are some of the things we're thinking about in terms of timing.
Sure. Julie?
Yeah, that aligns with my thinking too, and with our thinking. I think, Matt, you know, I talked a little bit earlier about our investment thesis. We're not making any major changes in that now. Sometimes I think people look at funds as these large monoliths, but we're entrepreneurs too, right? So we have a small, you know, micro regional fund, and so we're watching the landscape just like everyone else to see, you know, if there are adjustments that we can make to have our investment dollars be effective. And I think we'll know more as things progress. But right now, we're not making any hard shifts in our thesis or philosophy or approach. We usually look at about 300 companies a year. We have conversations with somewhere between 150 and 200 of those. And you know, any company that is in Oregon or the Pacific Northwest that has revenue that falls in that valuation range, you know, we're interested in having a conversation with.
And Tom, I want you to answer this question, but I want to interject for a moment if I might, because that makes me think. Also, can Julie, and I'll come back to Matt and then Tom can answer as well. Do you think this is a time that more companies are going to be formed, as often happens in a downturn? Or do you think this is more of a blip that people expect isn't going to necessarily last that long because of the source being a virus versus some sort of, you know, like the mortgage crisis or that sort of a financial crisis initially? Anyway, do you think there are going to be a lot of new companies formed during this period or not as many as one might expect?
I think we will see more new companies, but I think there's going to be a slowing, and then we'll see that, as Matt talked about, because people will, you know, I mean, the two businesses that I started in downturns, and it just happens because people have time and space and inclination, and they thought, well, a lot of it is that people thought that they were secure, and then they lost their job, and it's like, oh, I'm really not that secure, so why don't I just become an entrepreneur like I've always wanted to?
Right on.
And
right, exactly.
And so I think we'll see some of that, and oftentimes, you know, a lot of the economic downturns that we have had have been because of single industry failures or something like that. This is more systemic and global, and it's just, I think it's difficult to tell what will happen in the next 6 months. But being entrepreneurial, you know, I'm an optimist, and I think that out of constraint comes innovation, and as both Matt and Tom have talked about.
Thanks. Matt, do you have anything about that specific piece of the question about more or less fewer companies being formed these days?
Yeah, I think there'll be a couple phases. I think right now there's probably fewer companies being formed. I mean, we're still in a shock. I actually do think it's going to be pretty long lasting. We have millions and millions of people have lost their jobs. You talk to some of the really impacted industries like the airlines, they're thinking about 4-year recovery times, not 2-year recovery times. I think other industries will be faster. So I think there is a phase where, people aren't jumping up to go start companies maybe this minute. But I think as sort of people get used to a new normal, as maybe that opportunity cost of leaving a job, or maybe it was the decision was made for them, starts kicking in. I think we will see a lot of companies over the next, let's call it 24 months, being formed. And I think probably just as importantly, we'll see maybe a higher number of great companies being formed in that period. And maybe I'll go out there a little bit. I'll say in the next 18 months, we will invest in one of our greatest companies, I think.
I like that optimism. Tom, what do you think about this question?
Well, the first one that's on the slide is yes. And the reason is simple, which is that this is, like I said, it's a big impact on everything. Everything. As Julie pointed out, this is not due to some industry failure or, credit default swaps. This is affecting us all in a very major way, and it affects us, not just the economy, but socially and the way we behave and economically, and it affects us globally. It is at a time when when you do a strategic analysis, you do what's called a pestle, where you look at political, economic, social, legal, and environmental trends that affect business. And we're all aware that there's been now for 4 years at least, a political trend that is changing global economics and changing domestic economics, and how that all works. So I think you have to remember that the only thing constant is change, and everything's changing, and recognize that it is going to be different. It is not, Matt's right, this is not going to go back to the way it was in January, whenever this happens, until we have a vaccine, and until people believe in the vaccine and believe that if they go out, they're not going to get sick and die, then, our behavior will continue to be modified as it is right now. People will be working more at home, trying to do that. The event industry may take a while to recover. The airline industry, travel may be down, as Matt noted. All of this stuff is going to happen. So yes, it's going to change, and predicting it, the only thing you can predict is that those things will happen. Therefore, you now start looking at the investment, and you do the same thing when you're looking at starting a company from that perspective and say, well, if I want to start a company, what can I do that can take advantage of this? Like Julie and Matt, I do believe that there will be more companies, to answer your second question. Like Julie, Crowd Compass was started in 2009 and 2010. It was right as the whole thing collapsed. The good side was that all of a sudden there were people available, and they were ready to work, and they were open to trying something that was riskier. So I think that will happen. I'm seeing it now, for example, with people that I know who have children that were in college who were looking for internships. Now they're willing to consider unpaid internships, maybe for equity in a startup. That might be really interesting.
So I have a question, apparently from someone, Tom, who knows you. And the question is, Tom, you always talk about how planning is everything, but plans are useless. How would you apply that sentiment in these times?
Well, that phrase is, I like that phrase. It's Eisenhower paraphrasing Sun Tzu in The Art of War. For better or worse, the word strategy itself comes from the military. But that was Sun Tzu. He was all about planning. But what he knew, and what everybody knows in business, as in battle, is that you plan all you can, you find out all the information you've got, get all the data. Data is your friend, as Julie pointed out. But as soon as the first shot is fired, there's no predicting what's going to happen. We know this when we look at a plan that a company has. And so that's why I say the first and the last thing an investor considers when they invest is the people that they're investing in and the leaders, because we know everything's going to change, and we want leaders that can lead a company that are going to be able to adapt to it. So I say that's how it applies right now.
Okay. We have another question asking what the panelists think, and I'm happy. I think we can start with Matt, and hopefully we can be brief because I know we're running out of time. But how are you all, each of you, feeling about, the possibility of Oregon sort of reopening for business, if you will, at this time?
Wow, that's a hard one to be brief on. I will try. So I think my sense is the West Coast has done pretty well on kind of social distancing and doing the things to flatten the curve. We try to stay in touch with hospitals, critical care docs, people making decisions in other states. I think we're going to see people experimenting at retail here pretty soon with some sort of models over the next, 30 to 60 days. I think that's probably, I don't want to go out too far because, I don't know. But I think if you kind of zoom out for a second, I think the West Coast has been pretty responsible in thinking about it. And so I think the plan will be thoughtful, and I think that'll enable us not just think about the reopening now. I'm actually worried about what the second wave could look like in the fall and winter. So I want to make sure we're making decisions now that mitigate that second wave.
Agree. Julie, do you have anything that you want to add to that?
Well, I mean, I think Matt said all this really well. There's a tremendous amount of pressure to reopen. I was looking at the models from the IHME, the group out of University of Washington that's been doing a lot of the forecasting. And in Oregon, the forecasting that they've been doing has been based on, I think it's a 45% less mobility in the population. And so I think right now for those people that can stay home, it's an important feature. The physical distancing is super important. I like the fact that the governors of Oregon, Washington, and California have banded together where they may have different plans, but they're collaborating in terms of what those might look like. So I'm the daughter of two medical professionals, one who's a public health doc, and I think that really balancing these things is going to be a tough go. So to do what we can do as individuals is really important. To control the things that we can control are very important. And the weird thing about this whole thing is that if we do it right, then nothing happens in terms of illness, right? And so for those of us that like visible outcomes, it's like, well, nothing happened. Well, that was the point, right? So I think there's a huge tension in this between economic well-being and people's lives and health.
I would agree. Tom, in the 30 seconds we have left, would you like to add to that?
Yes. So I think Julie's got it right. The constructive tension is between saving lives versus having to earn a living. I think Matt's got it right, which is there is a new normal. It's interesting to hear that there's a 45% mobility. Things are going to change, but it's going to happen. We can't wait for a vaccine. And different states and different regions are trying it. This will happen, and we will slowly find that something emerges.
Terrific. Well, I would it's 1 o'clock, at least by my clock. So I know that we had scheduled this from noon to 1. And so I want to thank all the participants who are listening to our discussion. And I certainly want to thank Matt, Julie, and Tom. Thank you so much for joining us. We really appreciate it. And hopefully this proved beneficial to those of you participating. Thanks so much, and have a great rest of your day, and have a healthy week.
Thank you.
Thanks, Brenda. Thanks, y'all.
Thanks.
Yeah.